We've got a real important topic to talk about today, and it is something that we've talked about previously. When we really zoom out from a broad lens, even further than macro, I'm talking bigger than markets, one of the concepts we've been following is how we're moving into periods of greater social unrest because of the way that information works nowadays. And how is information now different than it was before? Well, obviously the first thing is the internet. But even more than that, in the past decade, we've had social media become huge, right? And now all of us are digesting more information than ever before, than any human has had to ever. And not only that, but a lot of it is good information. Of course, there's a lot of garbage information too, but as more and more information comes down the pipeline, it gets more and more difficult to differentiate between the two. So we actually talked about this in a recent macro ops note. Lux Capital, in one of their recent posts, they talk about the diminishing and sometimes negative returns of accumulating more information in decision making. And we're going to talk about this information problem from a very broad perspective, and also, of course, how it relates to markets and what we do as investors. So the Lux Capital post said that one of the most important cognitive trade-offs we make is how to process information, and perhaps more specifically, the deluge of information that bombards us each day. A study from 2009 says that Americans read or hear more than 100,000 words a day. That's an increase of nearly 350% over the prior 3 decades. And this was before Slack and Substack. In 2009, that was before social media even became as crazy. Now, it seemed logical that more information is better for decision making, both for individuals and societies. Yet, that's precisely the trade-off. Humans and civilizations must balance greater and better information with the limits of their rationalities. So again, we could talk about this from the micro perspective as investors. When we have access to all this information, what do we do with it? And then also from a more macro perspective, our civilization, with all the information that everyone has access to, good and bad, but a lot of good too, it becomes very difficult for social cohesion. And we'll talk about this more in a second, but when we're talking from a civilization standpoint, take something as the idea that carbs are good or bad, say in diet culture. Right? You could find a ton of information, very convincing from great sources that says carbs are terrible, humans should not be ingesting them. Then you could find other information just as good, just as convincing that says carbs are actually required for us to live, and carbs are super important. So you have so much information, so much great information on both sides. How do you know what's real? How do you know which is the right side? And we're talking about something like carbs here, but think about bigger concepts, political concepts. It becomes a problem. And that's what happens. There's basically a marginal return to information, and it often reaches zero or even negative, and it's far earlier than we might expect. You've probably heard us talk about that study into professional horse bettors, where they found that a certain minimum amount of information, in this case 5 pieces about either the horses, jockeys, or the track, that helped the gamblers make better bets. But additional information actually stopped adding to their accuracy, but it did add to their confidence. So the guys that had 10 pieces of information were way more confident in their bets than the guys who had 5 pieces, even though the accuracy was the same. So more information beyond a certain threshold drove confirmation bias, which is really drinking your own Kool-Aid, but it did not improve predictive accuracy at all. All it did was lead to overconfidence. And these findings have been confirmed numerous times in follow-up studies. And this is also why you find diehard people on each side of the debate. And they could pull up so many facts and figures and all of that. With all that data, they become a little overconfident on their side. And that's why you can never even get conversations or discussions between two sides anymore, because everyone's so dug in on their side because they have all this information. They're overconfident. Now, of course, on the macro side, we could relate this to trading and investing, because what's our job, right? Synthesize loads of information in the hopes of creating an information and or analytical advantage. So we drink from a fire hose of confirming and disconfirming facts and figures. Data points about where the economy is headed, what the Fed is doing, how the war in Ukraine is impacting agricultural prices in South America. Why is cotton trading like an ARK holding? What matters, what doesn't, what's true, what isn't, and on and on. At what point does this information become too much? And what types of information should we focus on and what types should we not? And this is obviously something we think about a lot because, again, what's the name of this channel? Fallible, right? We're always looking for new information to either confirm or deny the current thesis that we're holding. And nowadays, there's a lot of information. So you don't want to over-confirm something and get overconfident. So how do you manage it? And you've watched our videos. We have facts and figures from everywhere. It's a ton of data. So a big part of the job is actually figuring out which data matters and which data doesn't. And that's a continuous process. So one example in the investing space is all the smart fund managers who made a name for themselves over this past cycle. And what did they do? They leveraged it into growth names. It was pretty simple. And now many of them have blown up. They gave back all their excess returns over the past 5 to 7 years just in the span of 12 months. And why is that? Because a lot of these names are down 70 to 90%. And these guys aren't idiots either. They are literally genius level bright. They know those companies inside and out. They modeled everything. They had their research, everything down to the bone. And if you talk to any of them on the phone long enough, you'll be convinced too. You'll want to buy a bunch of shares yourself. But again, a lot of those stocks got crushed. And maybe a few of them will go back to all-time highs in a few years, but most will go nowhere for 5 years, and a few will even go to zero. So you can't help but think that they had a ton of information, right? These smart hedge fund managers. But they obviously didn't have all the important information. And the excess of non-essential evidence may have given them overconfidence in their positions. It may have blinded them to incoming disconfirming evidence. And that's a deadly mix in the market. So it gets kind of weird because having the best research can actually work against you. Another example is this metals analyst from the Odd Lots podcast recently. So he's a super smart guy. He knew the metals market better than anyone. And he was giving an argument about copper. It was why copper may be one of the tightest markets the world has ever seen. You listen to that episode, you'll want to buy a bunch of copper afterwards. But you know what happened after that episode was released? Copper fell another 12%. It kicked off a new bear trend, and it's probably going to trade much lower. So what's that mean? Is that analyst an idiot? No, of course not. But there are a few rules of thumb that we could take from it. One is that once an investment thesis can be convincingly articulated, it's already too late. Whatever's going to happen is already in the price. So once you have talking heads talking about why supply is so tight and therefore an asset has to go one way, it's probably time to sell. And of course, that's only partly true. Really, what we're saying is compare the argument to what's happening in the price. But also be wary when you hear everyone talking about one thesis and they're all on one side. For example, everyone being super bearish stocks right now. Adam Robinson, who's a famous macro advisor, he was on the Tim Ferriss podcast a bunch of times. He talks about the no sense algorithm. So he said, when we think about investing, a problem is that we try to understand the world that is actually just way too complex to grasp. And this is a macro guy saying that, right? And the whole point of macro is to understand how the world works. But he says the more dogged our attempts to understand the world, the more we earnestly want to explain events and trends in it, and the more we become attached to our resulting beliefs, which are always more or less mistaken, blinding us to the financial trends that are actually unfolding. What's worse is we think we understand the world, which gives us a false sense of confidence, when in fact we always more or less misunderstand it. You hear it all the time from even the most seasoned investors and financial experts that this trend just doesn't make sense. It doesn't make sense that the dollar keeps going lower, or it makes no sense that the stocks keep leaping higher. But what's really going on when investors say that something makes no sense is that they have a dozen or whatever reasons why the trend should be moving in the opposite direction. Yet that asset keeps moving in the current direction, which is why it doesn't make sense to them. So that's what they believe, that it shouldn't make sense. But what actually doesn't make sense is their model of the world. The world itself always makes sense. I hope you took a shot every time I said sense. In fact, because financial trends involve human behavior and human beliefs on a global scale, the most powerful trends won't make sense until it becomes too late to profit from them. By the time investors formulate an understanding that gives them the confidence to invest, the investment opportunity has already passed. And that's why you see in the macro ops portfolio, we'll put on starter positions and things. And then we'll say we're going to dig into this more later. If you watched our video on the interview that Druckenmiller just gave, he talked about one of the ways in which the game is different now than before is that there's so much information that it's difficult to get an edge. And by the time you actually go through and do your due diligence, it'll be too late. So he does the same thing. He invests first and then asks questions later because he kind of relies on his gut feel. Or if a thesis just makes sense, invest and then dig in because there's no time anymore because there's so much information. And even if you dig into it, like Adam Robinson is saying here, sometimes it won't make any sense. But that's also why we use price in macro ops, right? Where the price is going is where things are going. It doesn't need to make sense to you for it to be happening. And I told you guys in previous videos, that's one thing I've been working on, not just in the markets, because it's actually easier for me in the markets, but in life in general. Instead of falling victim to that human need to control everything, which is also very much a Western philosophy, because you think what we're told growing up is like, work hard and you can make anything happen. If bad things happen to you, it's because, well, you didn't work hard enough. Or if you're not finding success, just work harder and success will come. Now, that's partially true, but what it really gets into people's heads is that they can control everything. So I'm trying to move more to the Eastern philosophy, which is see the world for what it is and go with the flow. I'll tell you what, it's a lot less stressful because you end up being more aware of everything and more flexible. And you ride the wave instead of trying to fight against it. Because if you stick too much to the idea that you can control everything, well, the truth is that you can't. And eventually you are going to get ran over. And I've been run over many times. So going with the flow, even though it sounds easy, depending on how you grew up, it might not be that easy. It's not super easy for me. But I will tell you, it's a lot more enjoyable and it's a lot less stressful. And it does go back to the idea that the world is is far too complex for all of us to just understand every little thing that's happening. It's not possible. Now, going back to specifically markets, there's also a timing component to all of this. So if we go back to the copper example, the copper supply issues that this analyst was talking about are real. Capital expenditure has been entirely too low for the last decade, especially if you think we're going to get anywhere near close to hitting these green energy targets. Lots of copper is needed to electrify everything. And copper mines take years to come online from their project start. But that's a long lead time kind of thing. It's like Chinese housing or the Fed tightening or increasing recession risk. And there's a host of other variables, once again, that we're unaware of. And those things drive demand in the interim. For example, the oil market was supposed to be tight since 2017, but it took nearly 5 years and negative prices to get us there. So there you go. There's some food for thought, right? And that's once again why in our process we use price action. We'll do the whole fundamental research, but if the thing's not breaking out and moving in the direction that we want it to, we're not in it. Because clearly something's wrong. And we're very aware that we don't know everything going on. See, this is where a lot of players in this game get lost. They can't understand the metagame. Because the fact is that there's often no real truth, or at least not on a time frame that most people are operating on. And again, in an investing example, yeah, a company is cheap, but it could become even cheaper. So there's a few things that we can take away from this. When the noise to signal ratio is high, when markets are real crazy like they are right now, and the cone of probabilities is wide, meaning there's probability of anything happening, we do better by limiting our intake of information to what we know is true, to what we know works. For us in macro ops, these are the few macro variables that are central to our process, technicals, and respecting the tape. So we track sentiment, positioning, and the development of narratives. So the stuff that we talk about in these videos and that we post about on macro ops, they are just a small subsection of tons and tons of information out there, but those are the key variables that we look at. Another thing you got to do is embrace your fallibility and understand that overconfidence fosters the type of get taken out of the game for good risks that we really want to avoid. Yeah, don't hold on to that loser. Cut your loss. You're wrong. And lastly, you want to follow a tested process with tested inputs. That way we can be properly informed when we deserve to have conviction and when we don't. As you can see, it's not easy, but you need to keep this idea in the back of your mind that too much information is not a good thing. You could even see in this video right here where we try to figure out how long this bear market could be. We look at past bear markets and compare, and it's interesting information, but is it useful? Click this video and see. Look at the data and see if it actually helps your process. So be a good test of what we're talking about here. So click this video and I will see you there.